Hey guys, Justin here with Investors to the Moon. Today I'll be talking about 4 classic mistakes people make and things to watch out for when investing. I can personally say I've either been tempted or fallen for these ideas before. If you learn something or like what you hear, hit that like button and subscribe. Remember, you can always unsubscribe later. It would really help me out. Anyways, let's get into it. Number 1. Listening to people and following others. All investors have agendas, especially peers. They have different experiences, successes and failures, and most importantly, investment strategies. They will therefore subconsciously show confirmation bias. Confirmation bias is a tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's prior beliefs or values. An example of this is I have a coworker who has a bearish approach to the market and in his positions. Bearish meaning he thinks the market in general go in a downwards trend. He also tends to tell me information supporting this. I also have a friend who likes to speculate in the market. He tells me to cut out my shares that are at a loss and swing them back into new shares. There are many ways to go about investing, but there are also many different circumstances between people. This is interesting because in New Zealand, where I am from, if you buy and sell international shares within a year, you will be determined to trade it and be hit with heavy taxes as opposed to holding for the long term. Therefore, from my point of view, I am less likely to benefit from the strategy my speculative friend was suggesting. This also holds true of viewing the market altogether. For example, a share may be getting a lot of trades and the market volume can be high, but some people may be purchasing it from a speculative point of view and pump and dump the share, whilst others may be holding it for the long term. This can cause a discrepancy between a fair market price and an overpriced share. Simply following the hype can leave you in a bad position, reaping losses. Number 2. X doesn't mean Y. I've seen time and time again articles that start with "this is why share plunged today" or "reasons why this share soared today." It can be easy to find information that fits the data after the fact, but correlation does not mean causation. At the end of the day, the price of a share is up to the demand and supply of the market. The fact that humans play a part in this means other factors such as fear, overestimation, and underestimation of information are possible. There is also vast amounts of information that can be interpreted from both a positive or negative point of view. For example, in my last video I said that NEO had to be bailed out by the government. I interpreted it as a good thing because it meant NEO had support from the central government, whereas someone could have easily said the business almost got bankrupt, meaning the company is no good. Be sure to watch out when people try to fit a picture that matches the data and to account for random disturbances and human error. Number 3. Buy at the dip. Intuitively, we are supposed to buy a share at a dip or when it drops in price, but what if I told you statistically you are likely to be worse off? I mean, of course in theory, buy low, sell high is the best strategy, but replicating this just doesn't happen well. Between 2010 and 2011, 112 tactical mutual funds were analyzed. These ETFs were trying to remove the downwards volatility of shares and bonds and simply buy at the downturn and switch between the markets depending on which market was doing better or worse. Only 9 of the 112 market bonds bet their 60-40 stock bond allocated fund. The reason being was they didn't account for the potential upside of holding for the full duration. They were blinded by the cost of being wrong initially and the short-term cost. In the book, The Psychology of Money, it is said Netflix increased by over 35,000% since its inception, but traded under its all-time high 94% of those days. Volatility is quite simply a fee we must pay for the potential gain. I have a personal story for you guys. In 2014, I wanted to buy Apple at $114. Keep in mind this was before the 4-1 split. The current closing was $115 and I thought, hey, I'll try shave off $1 from the price. Unfortunately, the price never dropped to $114 from that day. If I bought at the market price of $115 and held it today, it would be worth 4 times the amount. That is 100% annualized returns. At the time, if we do the math, I wanted a 0.8% discount on price, and clearly that wasn't much of a fee in retrospect. So guys, if you like the share, you've done the research, don't be afraid to just buy at a market price. Number 4. Buy in the recession. What follows from buy low and sell high is the idea to buy at the lowest point of a recession and sell at the height of a bubble. In the picture here, we see an example of why time in the market beats timing the market. We have 3 investors investing $10,000 from 2007 to 2017. The timeline starts inside the height of a recession for the first year and a half before starting to recover. We have investor A who holds from start to finish. We have investor B who opts out during the recession and re-enters back in a year. And we have investor C who chooses to opt out completely and invest in a savings account instead. Person A ends with the highest return, beating out both investor B and C's final value combined. Leaving the market for just a year caused investor B to lose out on $7,000 in value. Quite simply though, the best reason for not trying to buy in the recession is it's actually really hard to time. Hindsight is not a good predictor, especially when each step of the cycle changes in length and the duration of each full cycle. We also have different primary reasons for each previous recession, and to this day economists are debating the reasons for the length of each recession. This year we had a small market crash that only lasted a month or two, followed by one of the greatest bull runs we've had on a year-to-year basis. This was happening even with COVID numbers were rising in America and before the vaccine was introduced. Output in the economy was getting worse, yet the cycle did not seem to be affecting the share market. Put simply, the cycles and its effects are unpredictable, and waiting for a recession could once again mean missing out on potential gains. Now you may be thinking, I can beat the market, I can do this. Richard H. Feller, a Nobel laureate, actually studied overconfidence. He found plenty of evidence that people tend to overestimate their abilities in many fields, including investing. Couple that with the ability you might actually miss the market, and finally adding the taxes of entering and exiting constantly, you could be losing out more than you bargained for. Well, that's it for me. To conclude, don't just follow what people say. They have different circumstances and objectives to you. Check the objectivity of data, and that is not just fitting the picture. Account for potential randomness, fear, and greed of human decision. Don't try to beat volatility, you'll probably lose, and don't overestimate your abilities, even though you'll probably do it. And finally, don't get sucked into the idea of buying at a dip or in the recession. Thank you for listening. Leave a comment maybe of a time you missed out on big gains or any investor mistake you made early on, or even continue to do. I'll see you guys next time.